Hi, and welcome to the quantitative section of order book matching algorithms. Here, we'll look at a more in-depth look at how these strategies are implemented in the market in real time. Let's first start off by looking at FIFO and ProRata, some of the prominent strategies we looked at over this episode of order book matching algorithms. And so for FIFO, which stands for first in, first out, we'll look at the different timestamps of our market order book. And so we see right now we have 3 buy orders in the market, all for a different number of lots at the same price consecutively right after each other. So we see our first orders for 100 lots, our second orders for 50 lots, and our last orders for 150 lots for a grand total of 300 lots in 3 different orders for a price of 101.3. So we have 3 buy orders in the market right now. And so let's see what happens next. We have a sell order that comes into the market. And so this is for 200 lots altogether at 101.3, the exact price we're looking for in the market. And it's right after ours, our 3 buy orders are put into the market. And so using the FIFO strategy, let's understand how this market order gets executed with this incoming sell order. Our first order for 100 lots gets filled completely for 100 lots on our fill book. And that's coming from the sell order of 200 lots. And so we see our next order for 50 gets filled for a full 50, also coming out of the sell order for 200 lots. And so we have 50 left from the sell order of 200 lots, and that's what gets executed towards our last order for 150. And so we see the filled order book equals the incoming sell order of 200, right? And so now we should have a certain amount of lots left over from this fill book. And that's what we'll see. We see a residual order book for 100 lots. But just understanding the dynamic of FIFO is that it took this 200 lots, right, as an incoming sell order, and it just attacked our order book from first to last, right? The oldest order book in there to our last one, and it did the full 100, the full 50, and whatever was left over, which was 50, got executed to our last market order book. And then we have a residual order book now of 100 that will get filled with the next incoming sell order. And that's FIFO. So now let's look at ProRata. And ProRata has a different strategy of executing your order. So let's look at the same example here with 3 buy orders. The same sell order comes in for 200 lots at 101.3, the same market price. So if we look at our fill book here, it takes each individual order and it divides that by our entire market book order and then multiplies that by the sell order to give us an execution lots filled as a portion to our entire market order book. And so we'll see that our first order, 100 divided by 300 times 200 is 67. We do the same thing with our next order, right? 50 divided by 300 times 200 is 33. And then we do the same thing with our last order, which is 150 divided by 300 times 200 is 100, a portion. So our biggest order of 150 had the biggest execution order of 100 because that represents a bigger portion of our entire market order book. And so we'll see now, as we look at a residual order book, it's not just one order left over of 100. It is split up now, still equaling 100, but over our 3 market orders that were initially put into the market. So now we have a residual order book of 33, 17, and 50, which still equals out to 100. And we have a fill book of 67, 33, and 100, which still equals 200. And so it executes to the same, ending value for both fill book and residual order book, but just in a different manner compared to your lot size or your time. And so that's an important factor for both strategies here. So now let's take a look at VWAP and TWAP to understand execution algorithms that people will use and then professionals will use in the market. So here we have some gold futures right on our screen. If we wanted to take a time-based approach to this, we would use something called TWAP, which stands for time weighted average price. And so we'll look over this week to execute our large trade order in either side of the market over a time-based regimen. We can start at 8 a.m., have another order that goes at 12 p.m., and another order that goes at 2 p.m., and then we can get in the overnight markets. Let's say we want to get in at 6 p.m. or 8 p.m., we can have that. And then you just execute your order over, each time frame within the entire week of the market. And that's one way to get your large market, your large order completed within the market at a weighted price over this time period. So not everything is exposed to that exact price in that market, and you're not moving the market too much with your large order. So another way you can go about the market that's not time sensitive, it is still a little bit, but it's also takes into consideration volume, and that's something called VWAP, and that's your volume weighted average price. And so by the name, you can understand that when there's more volume in the market, there's more opportunity to execute your trade, right? If you think about it theoretically, right, if you want to really conceptualize what it means, is that when there's more volume, when there's more liquidity in the market, we'll want to execute more of our trade. And so if we throw on our VWAP here, we'll see that in the times where there's more volume, there's more separation from this just regular, moving average, moving of the price, to our volume weighted, but like bands on the market, because there's more volume in the market. There's more opportunity for us to execute our order during these times in the market. And so we also see the flip side of that is when there's less volume in the market, these bands start to contract on each other, and there's less opportunity to execute a large order in this market. And so let's look at that over this period, right? When there's more volume, there's some volume in here, these bands are wider. Less volume here, contracted, we start to see some more volume in the market, averaged out, we see a separation, a lot less volume here, it contracts. And so we see that all the way throughout the market here, and we see some really big ones with some really high spikes of volume. Of course, our bands are going to get much larger. And so if we want to execute a large order using this, we will execute a larger amount of our trade during times of more volume for more liquidity within the market. And the flip side, we would do less, right? We would execute less of our order during times of low volume and low liquidity within the market. And so this helps you get your order off quicker, two, still getting some adjusted price over that time period as well. And so there you have it. Those are two ways to execute your orders, large orders in the market, using two different strategies, TWAP and VWAP. And this is also coupled with our order book matching algorithms of FIFO and ProRata. I hope this gives you a better understanding of order book matching algorithms and how professionals use these in the real world.
Check out the entire Algorithmic Adventures Futures Discovery episode and much more at johnlothiannews.com.